A derivative is a financial instrument, or in a simpler way, a contract, whose value is dependent upon or derived from an underlying asset or group of assets. The most common underlying assets for derivatives are stocks, bonds, commodities, currencies, market indexes, and even interest rates. A rather simplistic analogy for a derivative would be a bet. If you have an opinion about the price direction of a certain asset, for example, you think the price of a stock will go up, you can usually find a counterparty who has the opposite opinion about that asset, meaning that he will think the price of the stock will go down. You can then agree upon the terms of the contract with that counterparty and place your bets. Depending on what the underlying asset does, you will either win or lose money. Of course, this explanation is way oversimplified, and you'll understand derivatives better once we look at examples, but it should be good enough if you want to explain them to your grandma. First, I would like to show you the size of the derivatives market compared to the rest of the economy. I want to do this so you can take them seriously and don't dismiss them as just another boring type of financial instrument. Here we go. By some estimates, the entire size of the derivatives market is around $1.4 quadrillion. As you can see, they are a pretty big deal, and that's why you need to understand them. Before I begin explaining each type of derivative, you are probably wondering, why do derivatives even exist? Why don't people simply buy the assets that they want? Why do they have to use these virtual assets? There are multiple reasons for this, but two of them stand out. The first reason has to do with practicality. Derivatives are really useful for the people who actually need them, like farmers. I will expand on this in a moment. The second reason has less to do with practicality and more to do with financial gains. They can be used to insure against price movements, also known as hedging. They can be used for speculation, to increase exposure to price movements through leveraging, and they can also be used to get access to hard-to-trade assets or markets. Since you'll understand them better if we look at examples, let's do that now. The first type of derivatives that we'll look at are called futures or futures contracts. You can think of a future as a legal agreement between parties that don't know each other to buy or sell something at a specified time in the future and at a predetermined price. The first futures were created for agricultural commodities, to give farmers a more predictable cash flow. This allowed them to sell their future crop at a specific price, thus protecting them as well as the buyers from the volatility and the price swings that are usually inherent in agriculture. Today, futures are also used by speculators who have no intention of actually receiving or delivering the underlying asset. They simply sell the contract before it expires, and hopefully someone who actually needs the underlying asset will buy it and hold it at its expiration date. They can also settle the contract in cash without having to actually deliver or receive the asset. Here's an example to understand how they work. Alice sells apples. Bob wants to buy apples. They enter into a futures contract which specifies that Alice will deliver 1 ton of apples to Bob for the price of $1,000 at a specified date. Sounds good in theory, but what happens in practice if in the meantime the price of apples goes to $1,500? Maybe Alice wants to back out of the transaction because she can get a better price from someone else. The opposite could also be true. Maybe the price will drop to $500 and now Bob wants to back out of the transaction because he feels like he's overpaying. To avoid this, they will both use a futures exchange, which will take care of all of this through its clearinghouse. The clearinghouse has multiple functions. First, it acts as an intermediary between Alice and Bob. Basically, it becomes a buyer for Alice in case Bob backs out, and it becomes a seller to Bob and oversees delivery in case Alice backs out. Technically, Alice doesn't have a contract directly with Bob, but with the clearinghouse. Bob also doesn't have a contract with Alice, but also with the clearinghouse. Even though the transaction is between them, they don't even have to know or trust each other because the clearinghouse takes care of everything. So how does the clearinghouse achieve this? How does it guarantee that both Alice and Bob get what they want without also backing out of the transaction? First, the contract with Alice states that if the price of apples at the expiration date is below $1,000, the clearinghouse will pay her the difference and she will still get her money. It also states that if the price is above $1,000, the clearinghouse will keep the difference. The contract with Bob states that if the price of apples goes above $1,000, Bob can still get his apples for $1,000. But it also states that if the price goes below $1,000, the clearinghouse will still get $1,000 from Bob and keep the difference. Since the clearinghouse is a seller for the buyer and a buyer for the seller, it takes on itself both the risk and the reward. Of course, this only solves the problem of trust between Alice and Bob. It only guarantees that both Alice and Bob can transact with each other because there's no counterparty risk between them. It doesn't solve the problem of either Alice or Bob backing out of the transaction. To solve this, the clearinghouse also requires a margin from Alice and Bob to guarantee that they will fulfill their contractual duties. This is a sum of money that they must have in their account with the clearinghouse. The amount varies depending on the market price of the asset that is traded. For example, if the price of apples goes up, this incentivizes Alice to back out of the contract, because she can sell her apples for a better price to someone else. For this reason, the clearinghouse checks the prices daily, and sometimes multiple times per day, and requires her to deposit more money in her account to make up for this difference. This amount goes to Bob's account. Since Alice has the money locked with the clearinghouse, there's no incentive for her to back out of the deal and lose that money. There would be no financial gain for her to do that. Whatever money she would gain by backing out and selling to someone else at a better price, she would lose an equal amount in her margin account. Her net gain would be zero. The same goes for Bob. If the price of apples goes down and Bob is incentivized to back out of the contract because he can get a better price from someone other than Alice, the clearinghouse requires more margin from Bob to make sure he won't back out. If one of them doesn't have the required amount in the account, he will get a margin call. A margin call means that he needs to put more money in to keep the position open. If during the duration of the contract everything went well and both parties had enough funds in their accounts, on the delivery date they will get their money back. They won't necessarily receive it as a transaction in their bank account, but since I don't want to complicate this video further, we'll leave it at that and say that for practical purposes they get their money back. Keep in mind that in the real world, Alice and Bob don't meet each other. Neither of them knows about the other's existence because everything is transacted on an exchange and it goes through the clearinghouse. This distinction is important because later we'll look at another type of derivatives called forwards, which are very similar to futures except they are not traded on exchanges. Now let's answer the question that you are here for. How to make money with futures? Keep in mind that Warren Buffett called derivatives financial weapons of mass destruction and time bombs. So, if an angry mob of Occupy Wall Street guys comes to your house to lynch you at some point in the future, I take no responsibility. As usual, I'll use a simple example to explain it. Bob gets into a futures contract for one share of company A at the price of $1,000. At the expiration date of the contract, one share of company A is worth $1,100 on the market. Bob pays $1,000 to settle his futures contract, receives his share, sells it on the open market for $1,100, and gets $100 in profit. That's it. If at the expiration date of the contract the price of the share is $900, Bob still has to pay $1,000 for it, and when he sells it on the open market, he loses $100. So why doesn't Bob simply buy the share and hold it? Because Bob is a degenerate gambler, and he likes to use leverage to amplify his gains. Instead of using that $1,000 to buy a share and hold it, Bob buys a futures contract because during the duration of the contract, he only has to pay the margin fee. Depending on the volatility of the market and the asset, the fee will usually be below 10% of the value of the contract. Basically, Bob gets access to an asset that is worth $1,000, he gets access to the profit generated by that asset, but he only has to pay $100 to do that. He doesn't have to lock up the entire amount of $1,000. He's still left with $900 that he can use to purchase more futures contracts with different expiration dates, which will allow him to control tens of thousands of dollars worth of assets. The only problem for Bob is if the assets go down in price. If that happens, he will get a margin call, and if he doesn't have the capital to keep his position open, he will get obliterated. Luckily for all of us, Bob is a small fish, and even if he gets a margin call that he's unable to pay, this doesn't have ramifications in the larger economy. It would be a big problem if financial institutions did this, but we all know that after the Great Recession, they realized this was too risky and they stopped abusing it. Oh wait. Now that we're done with futures, let's look at options. These ones are also tricky, but I'll do my best to explain them in a simple way. An options contract is similar to a futures contract in that it is an agreement between two parties to buy or sell an asset at a predetermined future date for a specific price. The key difference between options and futures is that with an option, the buyer is not obliged to exercise their agreement to buy or sell. It is an opportunity only, not an obligation. Futures are obligations. The way to remember them is the following. Options give you options, to buy or to sell. I will now sidestep a bit and explain a different instrument called the lease option. If you understand lease options, it will be easier to understand regular options. When you want to rent or buy a house, sometimes you'll stumble upon this lease option thing. What this allows you to do is to rent a place, and at the end of a certain period, you have the option to buy the place at an agreed price with the owner of the house. Obviously, besides rent, you'll have to pay the owner a premium to have this option. This premium is an amount of money that you give to the owner of the house so that he keeps it for you. He won't remove his house from the market and give it to you at a certain price if he has nothing to gain. This premium is his incentive. If during your rental period you notice that the price of houses goes up, you can exercise your option and buy it at the agreed price in the lease option. Since the price in the lease option is lower than the current market price of the house, this makes it a good deal for you. On the other hand, if the price of houses goes down, you could choose not to exercise your option. You lose the premium, but if the price keeps going down, it might not matter, because you could simply buy another house at the current market price, which is lower than the price from the lease option. This is similar to how regular options work as well. You pay a premium that gives you the right, but not the obligation, to buy or sell an asset at a specified time in the future and at a predetermined price. There are two types of options: call options and put options. A call option gives you the right to buy something at a certain price. To remember it, think about calling the asset away from the seller. A put option gives you the right to sell something at a certain price. To remember it, think about putting the asset up for sale. To understand how options work, let's look at the following scenarios. In the first scenario, Bob wants to buy apples from Alice. He tells her that he will pay a $100 premium for the option to buy 1 ton of apples from her in 1 month at the price of $1,000 per ton. By giving Alice $100, Bob bought a call option from Alice. He bought the option, but not the obligation, to call the apples away from her. Next month, the price per ton of apples goes to $1,200. Bob decides to exercise his option. He pays Alice her $1,000, she also gets to keep the $100 for the premium, and Bob gets his apples, which he can now sell for $1,200 on the market. Bob made a profit of $100. Alice technically lost $100 because she sold her apples for only $1,100, while they were worth $1,200 on the open market. Now let's look at the second scenario. This time, it's Alice who wants money from Bob, and she will give him the apples. Bob says he will accept to buy the apples from Alice in 1 month for the price of $1,000 per ton if she gives him a premium of $100. By giving Bob that $100, Alice basically bought a put option from him. She bought the option, but not the obligation, to sell her apples to him. Next month, the price of apples drops to $800. Alice decides to exercise her option and give Bob her apples. Bob pays $1,000, but he keeps the $100 premium, so technically he only pays $900. This means that Alice managed to sell her apples for $900, while the market price for them is $800. She can now go and buy another ton of apples with the money and still keep $100 in profit. Bob, on the other hand, paid $900 for a ton of apples that is worth $800, so he lost $100. In the first scenario, Bob was the buyer of a call option, and Alice was the seller of a call option. In the second scenario, Alice was the buyer of a put option, and Bob was the seller of a put option. With this in mind, try to remember the following. If you buy call options, you make money if the price goes up, and if you buy put options, you make money if the price goes down. If you sell call options, you make money if the price goes down, and if you sell put options, you make money if the price goes up. If you still don't understand how they work, it's not because they are too complicated, but because it's too much information all at once. Simply pause here and look at the examples again. Try to go through them step by step, and it will all make sense. Of course, things can get even more complicated. In the first scenario, Alice sold a call option to Bob. But what happens if at the expiration date of the option, the price per ton of apples is still $1,000 and Bob doesn't want to buy them? What happens is that Alice gets to keep that $100 premium which she charged Bob for the option. This deal was great for Alice because she got $100 for nothing, but it was bad for Bob because he lost $100. In the second scenario, Bob sold a put option to Alice. But what happens if at the expiration date the price of apples is still $1,000 and Alice decides not to sell them? What happens is that Bob gets to keep that $100. This time the deal was great for Bob because he made $100 without having to actually buy the apples from Alice. But it was bad for her because she paid $100 for nothing. This is why when people discuss strategies about options trading, a frequent saying is that options are made to be sold. In the examples above, only the seller made money from the options. Due to things like time value, time decay, extrinsic and intrinsic value, options trading tends to favor the seller more often than the buyer. I won't go into these concepts right now because I want to keep this video simple, but I'll probably get back to them in a future video. Now let's move on to the next type of derivatives, called forwards. When I talked about futures, I mentioned that the parties don't meet and don't know each other because the contracts are traded on an exchange. This distinction is important because forwards are very similar to futures, but they are not traded on exchanges, they are traded over the counter. Unlike futures, which are standardized contracts that can't be customized between counterparties, forwards can be customized to a commodity, an amount, and a delivery date, because the parties know each other. Since forwards are traded over the counter, the details of the contracts are restricted to the buyer and the seller and are not known to the general public. This makes the size of the forwards market difficult to estimate. It is believed that the market is quite huge, because most corporations use forwards. Let's look at an example. Alice has 1 ton of apples to sell 1 year from now. The price for 1 ton of apples today is $1,000, but Alice believes that the price will go down in 1 year. Bob needs apples in 1 year, but he also believes that the price of apples will go up by then. Bob offers to buy the apples from Alice for $1,000 in 1 year, but Alice refuses because she could simply sell them now and get that amount. Why would she wait for Bob when she could simply sell them now, take that money and put it in a bank or in a 1-year treasury and receive interest on it? If she waited for Bob, she would have to give up on this opportunity. For this reason, she will only sell to Bob if he agrees to pay her $1,050 for the apples. This way, Alice has a reason to wait for Bob, because this new price accounts for her cost of opportunity. Since Bob believes that the price of apples will be higher than $1,050 1 year from now, he agrees to enter the contract. In 1 year, the market price of apples has 3 possibilities. The first possibility is that it is exactly $1,050 per ton. In this case, both parties are happy about the transaction because technically neither of them lost money on it. The second possibility is that the price is higher than the contract price. Let's say it's $1,100 per ton. In this case, Bob is happy because he was right that the price will go up, but he only has to pay $1,050. The third possibility is that the price is lower than the contract price. Let's say it's $950 per ton. In this case, Alice is happy because she was right that the price will go down, but she still gets to sell her apples for a higher price. Bob is upset because he was wrong about the price and now he's forced to buy overpriced apples. Since forwards are between 2 parties and there's no exchange involved, no clearinghouse involved, and there is no margin, the risk of one party defaulting is higher than with futures. The last type of derivatives are swaps. I won't even bother trying to explain swaps for 2 reasons. First, swaps are for institutional investors and not for retail investors. Retail investors means you or me. They are not for us. The second reason is that they are so complex that it would probably take multiple videos to explain, and I don't see the point in that for either you or me. If you want to understand them anyway, I'll put a link in the description. See you next time.